Controversial changes to the capital gains tax and negative gearing appear to have further spooked already wary Australians looking to enter the housing market.
Negative gearing isn't gone, it's just delayed. First home buyer lodgements, 20% down since the budget. That's enormous.
The government's done in terms of adding these incentives for first home buyers, but then pulling the handbrake on property prices from a negative equity position. 99% of these investors out there are going to be mum and dad investors where the goalposts have changed.
Westpac said 20% reduction in their entire investor lending book. In terms of lodgements, 25% down. So you could see a 20 to 30% change in borrowing capacity. If you were pre-approved, all of a sudden it's 30% less than you could borrow. You're paying about $45,000 in interest just to hold this property. All of a sudden you're down 15 to 20K per annum that otherwise you would have gotten a tax benefit from. So for a mum and dad investor looking at this position now, can you come up with that shortfall every month? But can you sustain it? That's now a serious question.
Michael, big episode today. I really want to get your take on the current environment, especially from a banking and lending space post-budget. I want to get your opinion on interest rates and talk through what you're seeing in the market from an investor standpoint, and also some interesting takes on first home buyers.
Yeah, so we want to see and talk about what is actually happening from a lending perspective. Are investors still lending? Are first home buyers picking up the slack? What's the borrowing capacity look like for investors? And what are interest rates doing over the next 2 years?
You're listening to the Follio Property Podcast. I'm Reece Bettle. I'm here with a special returning guest to the podcast. Probably 12 months ago, we had you in this room. He is the director and founder of Tusk Finance. He's the host of the Backyard Property Podcast. Michael Killiner, welcome back to the Follio Property Podcast.
Hey, thanks for having me back. It's a pleasure. There's been a lot that's happened since 12 months ago, so I can't wait to unpack it.
100%. I think that was one of the big reasons I want to reach out to you is you and me catch up pretty frequently outside podcasting world, but a lot has changed post-budget. I just want to get an inside opinion from yourself. How does the lay of the land look post-budget in terms of your world, from a client base, from a banking environment?
There's a lot of numbers that are thrown out at the moment in terms of investor lending, first home buyer lending, and I think the key is a lot around uncertainty. And so I feel like that cloud is lifted based on it being legislated, the changes in the budget, which no doubt your listeners have well across. But in that period before it was legislated, there was a lot of uncertainty around what was actually going to happen. Now we know what it is, we can actually then implement strategy. And from a lending perspective, that also goes on the back end around the way banks look at your lending position. So how much can you borrow is different today than it was 2 months ago. But at least we have a clear idea on what that looks like. And you can also see the transfer into what people are actually then doing. So are first home buyers taking that leap forward into buying a property to account for the investors that are not doing that at the moment? And that's really fascinating behind the scenes.
If you're serious about property, you need better inputs. PropStack is where our chief economist and research team puts everything together. Our leading investment reports, our suburb level data, and a weekly market update on what's actually moving. It's the same research our advisors work from, and you can get access now. Scan the QR code and click the link in the description. Let's go there, because we spoke off air and some fascinating feedback from yourself. So we always say we're not a political podcast, but a lot of times it does lean that way, just naturally what's going on in the property market at the moment. We've spoken at length about what the government's done in terms of adding these incentives for first home buyers, but then pulling the handbrake on property prices from a negative equity position. Now, there's a lot of politicians coming out at the moment praising the policy changes have done the right effect. Markets are cooling. Sydney and Melbourne are, Sydney tracking for double-digit negative growth in the next 12 months. What have you seen from a investor lending activity versus a first home buyer activity? Have we seen more first home buyers into the market, and are we seeing investors fleeing the market?
So I think covering off that first part, really passionate around that first home buyer guarantee scheme. I know this podcast has touched on it before, but the reality of bringing forward a policy that incentivizes first home buyers to enter the market, and society's telling them to enter the markets, they do, and then 6 to 8 months later changing policy that now is affecting them, that's a really harsh reality for a lot of first home buyers. You don't realize you've lost until you sell, but that's a harsh reality. So I think parking that, because we're moving forward in a positive light, the data is showing, and some of the banks are coming out and saying this publicly, like Westpac, and others are hiding behind the broker aggregators. So if you look at The large ones, you've got Loan Market Group, you've got Lendy, which is Aussie as well. And so they're reporting a 20% reduction in first home buyer applications. So first home buyer lodgements, 20% down since the budget. That's enormous.
And that is the market we were anticipating, or the government was pitching, is going to see an increase. There's more opportunity out there.
Yeah, exactly. And then you look at investor lending. So Westpac said 20% reduction in their entire investor lending book. In terms of lodgements, 25% down. 25% down on lodgements for investor lending. So there's no surprises that we're seeing a big jostle amongst the banks around interest rates, valuations, trying to win business, because in the back end, they're not getting any business.
I mean, interest rates is the other big driver, I think, that's probably changed the economy. Let's talk from October last year with the first home buyer incentive scheme that came out. There's been 3 rate rises since then, and a lot of sentiment probably around the Iran war and the lead up to the budget was there's going to be more rate increases this year. As a podcast, we've probably had a pretty strong opinion that we think that there's going to be no more and potentially some rate decreases towards the back end or beginning of next year. We had Reedham from Flint Mortgages, who I know you know as well, and he had some really bold claims. I can't remember off the top of my head, but it was 6 or 7 rate drops in the next 18 months. We've now got some big hedge funds now doing the biggest shorts since 2010 against some of these high street banks out there, as far as, you know, share price dropping down because they're losing a lot of that lending that you mentioned there. Where do you see interest rates for the rest of 2026? And how much of an impact will that have on clients borrowing?
Yeah, it's funny because last time I was on, you had the same question and I got the prediction wrong. So I'm very mindful around that.
Don't say that.
I'm also very mindful around what Reedham said because was a fantastic economist and now a fantastic broker. So I certainly take what I'm saying with a pinch of salt. But I think based on data, for me, I'm looking at inflation. Naturally, I'm looking at GDP and I'm looking at unemployment figures. And right now, it's really being toyed across. It's a bit of a tussle between those 3. For me personally, and the way that the data's sitting, I can't see rates dropping this year. I just can't see it. And unemployment, you could argue, is not quite in line with the reality in terms of public sector unemployment versus private sector unemployment. And we can go deeper on that. GDP, if you then looked at GDP and said, well, we're bringing in an enormous number of migration into this country, and so that props up GDP. But per capita, our GDP isn't going anywhere. It's in fact shrinking. So GDP is nowhere near as strong as what the headline rates are saying. And obviously you've got inflation. And there's the trimmed inflation, which is just that the basket of goods that haven't increased as much and decreased as much, so 70% of it, rather than the 15% at top ends. And so you're looking at that and saying, well, based on that, I just can't see rates dropping this year. Will they increase? Well, there's a strong idea that they're not going to increase either. And I can see a really steady rate market, and that's a good thing, in my opinion, because we know what we're heading into. And fixed rates haven't really moved. There's been a bit of a jostle, but haven't really moved. And that's generally a future prediction as well. So in terms of 18 months, I personally can't see any changes in the next 6 unless we get some inflation data that's actually quite scary. And the next set comes out on the 29th of July. And then you say, well, the next 12 months, is there going to be a rate reduction then? It's highly likely, yeah, because you're already seeing this flow-on effect of less investors, less first home buyers. All of a sudden, there's less confidence as well.
I mean, rates are obviously linked to serviceability at the end of the day. And I think people in the finance mortgage world like yourself and the property space like us, rate is, you know, the most important lever. It's probably more serviceability and it's a debt game at the end of the day. And that's probably an interesting segue into the serviceability that banks and lenders are having post-budget, particularly from an investor's standpoint, is probably what I want to have a chat about. And it's been an evolving market post-budget where lenders are probably trying to update their systems and come out with new serviceability models. But talk us through what the banks are doing post-budget with no negative gearing and explain, you know, why there is a bit of a difference in terms of how much they're willing to lend to clients.
So post-budget, before legislation, the banks, it was chaos. So any of your listeners that are investors, which most of your market is, if they've applied for a loan post-budget, they would have seen a very different application process to what it was pre-budget. It's so much harder than it was. And now that's slowly easing, right? But in terms of the bank's calculators, before legislation, the banks either turned on the tax deductibility or they turned it off. And so you could see a 20 to 30% change in borrowing capacity by doing that. That's enormous. So if you were pre-approved, all of a sudden it's 30% less than you could borrow. Now move forward to where we are today. Most of the banks have changed their calculations behind the scenes. So what they're doing is saying, well, as the legislation says, you are getting charged an interest of X, and we will now deduct the rent up until that point of that interest that you are paying. So there's obviously not coming off your taxable income, but it's coming off the rent. In terms of the way it's been calculated, it's much more in line with legislation. So you're looking at about a 10% reduction in borrowing capacity as opposed to pre-budget.
And would that be pretty consistent across the board? Because, I always try to pick your brain every other month regarding, what lenders are doing, what banks are doing. I know non-banks in the private credit space have been gaining serious market share in the last sort of couple of years in Australia. Are they more relaxed on some of these rules, or are they, the same as what the majors are doing in terms of, capping that serviceability?
Yeah, so the serviceability position is very similar from a tier 1 to a major bank to a tier 2 or 3. But what is different is still the assessment rate. APRA, the regulator, has stated you need to have a 3% buffer on the interest rate. So say you're getting charged 6.5, they're assessing you at 9.5 as an investor. And so if you're going down that tier 2, tier 3 lender, it's a 2 or a 1% buffer. So you're relying more heavily on the assessment rate buffers than necessarily the tax deductions that you were otherwise getting. From a negative gearing perspective or tax deductibility perspective, it's very much similar. But what you're relying on then is very much the assessment rate. You're also relying heavily on the way that rental income is being assessed. So some banks will accept 80% of rental income, some 90%, some 100%. There's so many policies that the levers you're trying to pull to get as much accessibility as you can, then you'd sort of lean into that tier 2 and 3 lender.
What about sort of company and trusts maybe becoming a little bit redundant, but especially in the company structures? It's been a big 6 months from a lending perspective. If you're an investor, with APRA coming out, I think it was debt to income first, then it was the removal of trust lending, especially from the majors. And then obviously we've had the rates rising, the policy changes as well. What about that non-bank space? So, outside the majors there, are they still playing? And is it, because that's been a big question for us, right? Off the back of the budget, loads of people are now coming to us who probably some aren't in a position to go down that company structure route, but they're just trying to clutch at straws to understand, okay, where can I get how can I get into the property market from a lending perspective? Are you seeing the non-banks being a bit more relaxed with that sort of stuff? And does it still exist in those channels?
I would anticipate those non-banks will relax even more following the SMSF change. So the self-managed super funds, a lot of the non-banks were in that space to generate their profit margins. That's now been pulled. It's well publicised. So I'd say that we'll see more relaxation in that space in terms of entities. You've still got NAB. NAB will still lend to trusts, companies, and they'll give you an offset account. So there's Beyond Bank will still do it. And you've got a number of the other majors that will do it if you're an existing customer. So it still exists and people are still using those structures. Trusts less so, companies more so, non-trading companies. But then you've got the likes of those tier 2, 3 banks that they're still doing it as well. So I think there's going to be a real jostle for this market share. As I've said, if you're down 20, 25% of your market share, you need to find the business somewhere. But the problem the banks have got at the moment is there's been enormous fraudulent cases in this space as well. So income accessibility and checking salary credits, checking your income is legit, has become, there's much more of a microscope on that as well. So there's a number of moving parts in the background.
I mean, I think it was NAB had come out with a forecast of how many million they're going to be losing this year off the back of the fraudulent case. I think a lot of the majors had recently come out and indicated. Are you feeling that from a processing standpoint as well, from a broker's standpoint?
Yeah, absolutely. The policies are still the same in terms of what they require. So yeah, it's ID, 2 payslips and whatever else on top of that. But the reality is they're looking at that so much harder in terms of what the data suggests. Is the tax position still the same on your payslip? Is the ABN reflective of the company you're working for? So they're getting much more stringent around what your documentation says. And in the back end, is your salary credit still matching what your payslips are showing? Most people are fine. But the reality is you need to make sure that you've got all of the documents ready, because that is under spotlight at the moment.
It's fascinating, hey, because that's all come off the back of the AI boom and people manipulating So you've got the AI boom, which is meant to make processes easier, but we're actually having to revert back to the old school way because we've got clients manipulating the system as well. So even what you're saying there, I spent 10 years in the non-banking world, and that is the level that we would be doing because we were attracting a certain type of client that may have, tendencies to do that sort of thing. So it's fascinating hearing that the majors have now gone that way and gone more of a manual process to rule out some of that fraud.
Well, it's not manual. It's AI versus AI. That's where we're at now. So it's the AI agents the banks have built versus the AI agents the fraudsters have built, and they're coming together. So we're just sitting in the space of going, well, which one are we believing in?
And are the banks and lenders pretty open with you, like from a broker perspective, that like this is what's happening? You need to be more, or your aggregator, for example, as well. Are they requesting more documents up front, or has it kind of been a process similar like with the serviceability requirements changing post-budget? Are you just learning as you go because they're getting a bit more stricter?
Yeah, learning as you go. This is it's an environment that's continuing to evolve. And whether it's the banks telling you this information or whether it's an aggregator that's telling you the information, either way, you've got to bring it on board, you've got to implement it, and then you've got to try and educate your customers or clients or whoever they might be that this is the new lending world we're in and this is what we have to apply to right now. And it reminds me a lot of in 2017 where they changed the interest-only caps and they could only have so many interest-only loans under their books, and there was much more requirements around that. I think this just continues to evolve and it's a watch this space.
Absolutely. I think from our perspective, we've definitely seen, from an investing standpoint, the goalposts have changed. You have a lot of people out there coming out saying nothing's changed, we're still doing the same investing as we were doing pre-budget, but 99% of these investors out there are going to be mum and dad investors where the goalposts have changed. And it is now, you're mentioning here, although they've improved, the serviceability is getting capped by about 15%. You've obviously haven't got the negative gearing benefits up front. You do on the back end, but it's really about protecting your cash flow now. And it's probably finding assets that have that good long-term fundamentals from a capital growth perspective, but also it's about protecting your cash flow, not just to get into the market for that asset, but to potentially grow a portfolio in this market. I think the goalposts have changed.
Yeah, they haven't. Its cash flow is, like we always say, cash flow is king, but it's now more than ever. Like if we did live data right now in terms of the way it's being looked at, for me, you're saying, well, an investment, let's call it 700K, right? As an investor, I'm wanting to borrow as much as I can against the investment property. So if you're saying $700,000 as the loan at 6.5%, you're paying about $45,000 in interest just to hold this property. How much rent should you get from a 700K property? Let's call it $600 a week, right? So you say $600 a week times by 52 is $31,000. So all of a sudden you're down $15,000 per annum just based on interest to rent. That doesn't account for any of the other costs, property management, land tax, strata, whatever it might be. All of a sudden you're down 15 to 20K per annum that otherwise you would have gotten a tax benefit from. So for a mum and dad investor looking at this position now, can you come up with that shortfall every month? Well, you're having to make that decision of, do I actually invest in property? I still believe in it. And it's also, I'm biased as well, but I still believe in it, but you need to make sure your cash flow's there.
100%. I think even in that scenario you've said there, a lot of investment groups that entered the space over the last 5 years was get into a market, get out of a market. But if you can't guarantee that growth now, that strategy doesn't work. I think in this market with an example like you've said there, a medium to long-term hold makes complete sense because you will then go through a period where that becomes positively geared and you're able to ride it out and offset any of the future gains off the top of it. But from a cash flow perspective, it is all about protecting that, I think.
Yeah, absolutely. Because negative gearing isn't gone, it's just delayed. That's the reality of it. You're just needing to make sure you get some capital growth in that journey. Yep. But can you sustain it? And then we talk about lending structures and say, well, how do I sustain this cash flow position that I'm taking for this investment? And do I change the way that I structure my home loan? Because that's now a serious question. Say, well, am I going to be in that home for long term or not? So you start go, well, hang on, we need to work out our lending structures before we pull the trigger, know your numbers and know what that actually looks like.
We got Jono in the building today, who's our podcast producer, and he wanted to get you in for an episode on how to pay off your mortgage, which did really well last year. But you and me started having a chat over the last 40 hours, and I think the question was, should you be paying off your mortgage in the new environment? So from your perspective, Michael, do you think people in this environment should be paying off their principal place?
Depends on your objectives. And I know that sounds like you're sitting on the fence, but that's the reality. So if you bought a property pre-budget, then you have the ability to apply the old negative gearing rules on that property in the future if you decide. My view is if you're looking at holding this property long term, then yeah, pay it off. If that's your future home for you, your kids, your family, then yeah, pay it off. Put your money in your offset, redraw. It does the same thing. People are more tempted to touch the offset account rather than redraw, which is why that could come out best. But the reality is, if you get a loan of $700K, you're going to pay about $750K worth of interest on that plus paying it back, if that's the way you look at it. So is it worth paying it off? My view is no, because I feel that interest-only facilities are really worth exploring. But if you're going to live in that home long term, then yeah, I believe you should. But I think if we want to go into that interest-only area, I'm all for that.
How are banks going to look at that's the big thing is if you do have, say, an $800,000 loan on your principal place, you got $750,000 in your offset, your repayments are obviously, but that figure will change, right? You got salaries coming in, you got expenses going out. So 1 month, your repayment might be $800 a month, it might be $1,200. How would a bank look at that from a serviceability factor? Because that would be my only concern with that strategy is, will they take the repayment, or will they go on what the reduced payment is with the offset? I'm just thinking for future investment purchases.
Yeah, so it depends on the lender policy. So if you're saying what's the actual repayments, there's a number of second and third tier lenders that will use actual repayments. All of a sudden, then you get a tick there, right? And you say, well, we're utilising that policy to help us with borrowing capacity. Other banks will say, well, if you've got an interest-only facility and say you've got a 30-year loan term and you've got 5 years interest only, they'll then assess you at 25 years. So yeah, it will affect your borrowing capacity in that respect. And you say, well, can I afford to reduce my borrowing capacity? Well, maybe I can close a credit card. We know that credit cards reduce your borrowing capacity by 5 times the limit. So close that 10 grand, 20 grand credit card, and all of a sudden you've got 100 grand borrowing capacity to play with. Then you can go interest only. So I think it's just using the levers to your advantage.
And that's where proper advice is going to come in, right? Because we've spoken about this off air where we both do like that strategy. If you know it's not going to be forever home, it probably does make sense to not pay off that mortgage. But you obviously, we're in a world where we want to be proactive and make our money work for us with the way inflation is. So wanting to have that ability to go again. You mentioned there's some bad debt like credit cards you got to watch out for. Just talk me through, just to go back to the example where you've got the money in the offset and you mentioned there are non-banks or second tiers that will potentially look at what the actual repayment is, so increase your serviceability by a fair amount there. What's a rate difference between, should someone be, and as somebody who worked in that space for a long time, I was constantly pitching it isn't a bad option to go down that route, but from a client's perspective, what sort of rates and the service are they going to look at in the non-bank space versus going with the major that they would all they're used to seeing those signs all throughout their life?
0.3%. So it's not major, right? And if you looked at a $1 million loan, it's about $300 difference per month in repayments. You say, well, the key thing on that though is you marry the property, not the debt. The debt can change. And all of a sudden you've had the debt for 12 months and now the majors will only apply a 1% buffer, not 3%. And so you say, well, let's get in. For 12 months, we absorb the $300 per month extra so we can actually buy that better grade asset, which you guys talk about a lot. And then you say, well, after 12 months, let's use a 1% buffer and let's go to a major if we really need to or want to. I think people get so fixated on the loan they get at the time, thinking they're going to have it for 30 years. You'll probably have it for 2 to 3 years, and then you'll change it based on your situation. And I think that's the key. You need a quality asset. And if you have the ability to get there based on using a lender that you wouldn't otherwise have heard of or a tier 2 or 3, then you probably use it.
That's fascinating. And I don't think people are thinking that. And that's where a good broker like yourself is going to really provide value. This is getting you into this is a solution for you now. But once we go 12, 18 months down the track, then we can then take you to a major. So would that be the type of conversation you would have a client when you are placing them into that solution, or would it be let's just review in 12 months and do a review of your situation?
No, you're having that conversation right at the start. I think people are so concerned that they don't know all the options, and for anyone I talk to, they really just want to see 3 options. If it looks like today, what it looks like in the future, because you need to be making sure they're aware that you're thinking about the future for them. Because the reality is a broker shouldn't just be that transaction anymore. It's a long-term advisor, similar to a property advisor. You need to be there in that. If you're having that discussion at the start, same as mortgage insurance. Mortgage insurance has such a bad name. The reality is it's an opportunity cost. If I pay mortgage insurance today to get into a better property and then I can get it reimbursed in 10 months anyway, possibly, why wouldn't I do that? But if you don't know those things exist, then you're never going to do it.
Are you seeing that in this current market? And I'm probably being more specific to Perth for those that are listening outside Western Australia. Are you seeing a lot of upgraders at the moment in this current market?
Upgrades in terms of upgrading their family home?
Correct, yeah.
Yeah, that's huge at the moment. That's the majority of our market right now. Because firstly, subject to sales are back. So agents are accepting subject to sales as part of an offer, which we haven't had for years. And so all of a sudden bridging finance isn't as necessary. So subject to sale is back and therefore people are more comfortable to upgrade because they then know what the sale price is for their home rather than this unknown. So our upgrade is there, yes. This is really the last non-taxed capital gain that we have, major capital gain that we've got. So I think what you're seeing from advisors, accountants, financial advisors, they're also talking to their clients about upgrading family homes, making a capital growth to their family home so that they can then on-sell in the future or they can just live in a better property. So yes, absolutely.
From a debt perspective, I know you mentioned there credit cards and we've obviously spoken about the interest offset, on your mortgage. Is there anything else people should be looking at? Because look, at the end of the day, right, and this is an investor podcast, right, borrowing capacity now has been restricted. So any little lever you can pull is going to be like amazing in this climate. Outside credit card, which you've touched on there, is there anything else from a bad debt perspective that people should be looking to review or what are banks clamping down on at the moment from a bank statements perspective?
Yeah, I think a really interesting topic that I haven't touched on before is car leases versus car loans. And I don't want to go into the rabbit hole of that, but the reality is car leases destroy your borrowing capacity. Car leases are the worst thing that could happen to your borrowing capacity, way worse than credit cards and personal loans or car loans, because the car loan is generally over a 5 to 7 year period. The car lease builds in fuel, tyres, maintenance. All of a sudden, they're billing them $2,000-$3,000 per month in expenses for that car. That's the biggest issue I see at the moment for people's borrowing capacity.
And that is, and generally when you have a car lease, is there a loan periods like a car loan that's going to be 5-7 years, or is it an open-ended contract?
Open-ended contract. And that's the thing, like regardless of period of time for a car loan, let's say it is 5 years, that's just what they build the repayment on. So they don't really care when it finishes. They're just saying that is your repayment for the foreseeable future. Same as a lease, a car lease. They're saying that is your repayment on the car lease, pre and post-tax deduction. That's what we're going to factor into you as a liability. And then people will come back and say, well, I get the tax deduction though. Well, yeah, but you can't buy the property that you really wanted to. So is the car lease worth it, or do you convert that into a car loan? I'm not advocating for either, but I'm just saying people are so focused on credit cards and car loans. Car leases have a bigger impact on your borrowing capacity than those two.
What about debt recycling in this current environment? Is that still, that was a very popular strategy, obviously, so pre-budget. Is that something that, you see value in this current market? Yeah,
definitely. Obviously, this isn't advice for anyone personally. I'm seeing it a lot for shares. I'm seeing a lot for managed funds. I'm seeing a lot for ETFs. Because the reality is, if you have a $700,000 loan and you have $100,000 in savings and you're trying to work out where to invest, and property might not be your thing right now, for example, the last thing an accountant would probably say is investing that $100,000 from your offset straight into that ETF or that managed fund. The reality is you need to, or should do, pay that $100,000 into your loan, reduce it from $700,000 to $600,000, and then redraw it out of that loan to then go and invest. Because an accountant hypothetically would say that that is then being invested for rental return or return, and therefore should be tax deductible. And that hasn't changed from the budget that we've just had. So am I seeing that? Absolutely. Is it easy to do? Yeah. If you've got a salary and a debt, then you can do it. So why wouldn't you do it? Why would you go and invest that $100,000 directly into a shares when you could actually convert your existing non-deductible debt into deductible debt and just constantly do that over time?
What about like specific advice to clients? But Tusk has been around for 2.5 years now, and from your previous business, you're working from a broking perspective. You would have met with a lot of investors that had structures in play pre-budget do they need to be talking to their team to understand, okay, this is what it currently looks like, but with the new rules and if I want to keep going again, I need to look at restructuring? And what would be your generic advice to anyone that's in that situation that maybe does have an investment property pre-budget and is just trying to understand, well, does it make sense for me to go again? Can I go again? How do I do it?
I think you can't fix any mistakes you've previously made in a lot of cases. So your debt position for that property is generally what it is, and we need to work with that. What I am seeing is clients are much more savvy around their advice from their accountant. So because of podcasts like yours, they're actually talking to their accountant before they're actually making these decisions. And based on the changes in budget, especially around trust lending or trusts altogether, they just don't make sense anymore because of the tax implications. And so from a lending perspective, that's also changed significantly. So if you can't lend as much in a trust and you're getting taxed more in a trust, it doesn't really make sense. So people are much more inclined to get advice from their accountant before they actually come and see me. So yeah, to go to your point, are clients more savvy? Absolutely.
So you've been a mortgage broker for 11 years. You've seen a few different cycles from a macro perspective, but also you've seen a lot of lending changes, right? You mentioned there the interest only changes back in 2017. You've obviously seen everything through COVID. Now, we mentioned earlier in the podcast, you've got big hedge funds out here predicting, shorting the banks. They're seeing market share. I think you mentioned 25% drop in investor lending and 20% drop in first home buying lending. So these banks are obviously, they're going to want to get some volume into their books in the back half of the year. Do you predict or do you foresee any of these majors coming out with any aggressive policies that's going to drive volume, or do you think they're sitting back now and just waiting for everything to kind of settle over the next 12 months?
No, there's going to be a huge change, big shakeup. Yeah, there's talking about someone like Macquarie. Macquarie are the leaders in this space, and they have been for the last 2 to 3 years. They are certainly being proactive in that space. We will see some changes within their policies around investor lending and owner-occupied lending. And on the flip side, you've also got the way banks have been valuing properties over the last 12 to 18 months. As anyone listening, if you've got a valuation in the last 12 to 18 months, it has probably been inflated to what the current market actually is, allowing you to borrow more and therefore helping the banks with their lending as well. What I'm seeing is valuations are still remaining strong regardless of the market changing, and therefore allowing people like yourself, all your listeners, to say, well, actually, I've got more equity than I realised. What am I going to use for that equity? And so, yeah, valuations, policy changes. I don't think rates are going to change too much. They're very much on par with each other. There's a bit of back and forth here and there, but they're very much on par. So valuations, absolutely, and policy. And
is anything from post-budget perspective, and I know you mentioned earlier you have seen probably a drop in investor lending, but you obviously still, investor clients I should say, but you're still obviously seeing those come through your doors. What's, from an investor standpoint, like what are some things that they need to be wary of now before they sort of jump into acquiring a property? So this is talking, people trying to do it themselves, not going to property experts like ourselves, but what's sort of the one bit of advice you'd give to any sort of investor at the moment post-budget?
Sounds really cliche, but you need to know your numbers. The reality is you need to know your numbers. You have to know what your repayments are on your existing debt. Is that the right structure for you? And then what's your borrowing capacity on the next debt? And further to that, what's your step 3 after that? So what are you going to do in 12 to 18 months? That's so important right now. And you need to see a broker. Like, that's the reality of it. You just need to understand the policies and the calculations behind the scenes.
And then just to wrap it up, Michael, so what about those that I mentioned earlier? We're seeing a lot of people come to us now because the game's changed, wanting to go through company structures. What are you seeing from that end? And what would be your generic advice to someone who's thinking about going down that route? Is it the right fit for every single person?
I think you're still seeing more and more people go down the personal name. They're just trying to work out whether they buy in the husband's name, the wife's name, which entity are they buying in. But I'm certainly seeing the majority of applications are in personal names, especially because the majority of applications are upgraders and not investors at the moment. So if you are an investor, know which entity, know which person is buying the property so that you can be really clear about your borrowing capacity.
Michael Killiner, thanks for joining the Follio Property Podcast.